Okay, in this video, I'm going to be talking about a very big mistake that I see many beginners making that I firmly believe is holding back a lot of you. Put simply, that mistake is many beginners, they don't trade the market structure that's in front of them. They trade their risk reward ratio. So we're going to use this Euro CHF here for an example. This is a trade I hit the other day. So I went short, meaning I bet against it right here on this pop up right here. See this? If you look at my cursor, see that pop up into this little fair value gap imbalance, testing this level of resistance right here inside a premium market. That's where I went short. I went short up into that, and I kept my stop right above this fair value gap high. See that? Look at my cursor. That's a fair value gap high, and I targeted low of day. So it was about a 1-to-1 risk reward ratio. And so why did I keep my stop here? Why did I keep my stop above the fair value gap? Because if price was to ramp up and break the high of that fair value gap, at that point, my thesis was incorrect. I was incorrect about the market structure if it was to ramp up and break that high. That is why I kept my stop there. That is exactly why I kept my stop there, because at that point, it would invalidate my thesis on the play. I would be incorrect about the market structure. So like what a lot of people do is they'll go into the market having a set risk reward ratio. Like, for example, I'm only taking trades with a 3-to-1 risk reward ratio. So like, for example, I risk $100 to make 300. If I'm wrong, I'll lose 100. If I'm right, I'll make 300. And they'll approach the market every day with that mentality. Now, I'm not saying that is bad. There is a correct and there is an incorrect way to do that. The incorrect way to do that, and the big fatal error that many beginners make, is, for example, let's take this Euro CHF. They'll take something like this and they'll go short into that. Their PT will be low of day, for example. They'll say, hey, if low of day is my PT, I need a 3-to-1. That's my risk reward ratio. I need a 3-to-1. So like, they'll put their stop like right up here, for example, just a rough estimate. And they'll risk that because they need their 3-to-1. That's what they need. They're sticking with that 3-to-1 risk reward ratio. And what'll happen many times is over and over and over again, they'll get tagged out. They'll get tagged out. They'll get tagged out. And the reason this occurs is because these individuals are playing the risk reward ratio and they're not playing the market structure that is in front of them. They're not playing the chart. They're playing the risk reward ratio. And that is the big error that I see many people make. Okay. Now, again, if you go into the market looking for a specific risk reward ratio, that's not bad. There's really nothing wrong with that, but it needs to be aligned with the market structure that you're trading. Okay, again, let me say that one more time, because I know a lot of you come into the market looking for a set risk reward ratio. There's nothing wrong with that. Nothing wrong with that at all. Heck, I do that with small caps. I'll go with 1-to-1 in small caps whenever I'm trading small caps, penny stocks. But that risk reward ratio, it needs to be placed at a point where if wrong, the market structure would invalidate itself. Like, it would be placed at a point where you would be incorrect about the market structure. If it hits your stop out point, that's at a point where you were wrong about the market structure. That's how you need to do it. Don't play your risk reward ratio. Play the market structure. Again, don't trade your risk reward ratio. Trade the market structure that is in front of you. I placed my stop right here the other day because if it was to break the high of that fair value gap, that means I was wrong about the market structure, about the chart that is in front of me. I'm not looking at this from the lens of I need this risk reward ratio, so I'm going to put my stop right here, really tight, really tight risk reward. Don't do that, because you're going to get tagged out over and over again. Place your stop at a point where you would be wrong about the market structure. Don't play your risk reward ratio. Play the market structure. If the market structure allows you to keep that stop, that really tight stop, great. That's awesome. That's the way to do it. But don't force your risk reward ratio on the market structure. That is a recipe for disaster. And I see that holds back a lot of traders. If you enjoyed the video, leave a like, subscribe to the channel. I'll keep it coming.